Sam, and hello, everyone. Thanks for tuning in. What we're discussing today is a big deal. It's a game changer in the mortgage lending arena. The Ability-to-Repay rules and the qualified mortgage standards that have been issued as a result of Dodd-Frank require lenders to make a reasonable and good faith determination of the applicant's ability to repay the loan if it's a covered transaction, and there's some potential liability if that's not done. Obviously, you have a violation of the rule in the first place, but there's also a set of consequences much greater than that. So to protect themselves, lenders may choose to make qualified mortgages because those provide a measure of protection against liability. So some bankers have looked at the rules and thought, oh, man, this is going to be a pill. I just think we'll get out of mortgage lending. But we're here to tell you it's all doable. Is it convoluted? Yes, it is, but by the end of the program, we will have gone through the Ability-to-Repay rule so you'll understand what it will take to make a loan that satisfies the Ability-to-Repay requirements. We'll talk about the 7 options that you have for meeting them. Actually, 6 different options for satisfying the Ability-to-Repay requirements, and then 1 category of loans where you just flat don't have to worry about the Ability-to-Repay requirements. We'll help you understand why having a qualified mortgage may be desirable. It's not mandatory. Complying with the Ability-to-Repay rules is mandatory for covered transactions, but whether you do a QM or not depends a bit on your tolerance for risk. So we'll talk about, okay, if it is one of these flavors of qualified mortgage, how much protection do you get, and what is the risk anyway? What kind of potential risk of liability do you have if you're making a loan and it's not a qualified mortgage of some sort? We'll also talk about some unsettled issues. You know, they tell us that they are going to tinker with the definition of finance charge, and that's going to result in some changes. So we'll spend a couple of minutes on that, but most of our time is going to be spent on helping you understand how to get in compliance with the Ability-to-Repay rules on your covered transactions, what a covered transaction even is, and we'll help you understand each of the different options for demonstrating compliance with the ATR rules. The rules that we're discussing are from the Consumer Financial Protection Bureau. As you know, they came out in January to be effective next January, on January 10th, but once the original final rule was issued January 10th of 2013, they came back May 29th of 2013, and they published amendments to the final rule. So you have to kind of integrate those, and the alphabet soup section of Bankers Online is a great place to do that because we've got all the changes integrated and you can see the new language. Where do you find it? Well, this implements amendments to Truth in Lending, and where it falls within Reg Z is Subpart E, and the Ability-to-Repay rules and the qualified mortgage rules are found in point 43 of Reg Z, and there's some excellent staff commentary on that. So, Jack, sketch out for us the scope here.
All right, let's turn to page 4, and the main thing you need to know here is that the scope, what they call a covered transaction, is consumer credit transactions secured by a dwelling. That's the major thing you need to know. Now, we have some exemptions here, and some of them are practical, and you'll use them fairly often. Others, you can kind of take them off your list in many cases. Let's look at the exemptions. These are the numbered and lettered items on page 4 and on page 5. The first one, if you do home equity lines of credit, they're not subject to these rules. So we're talking about consumer credit secured by a dwelling other than a home equity line, other than a timeshare plan, as Mary Beth and I always kid ourselves about it. I mean, they get exempt from everything. It's crazy. Also exempt from C through F. And, folks, as we get through here, you're going, C, F, what are we talking about here? Well, those are the major rules of this section. The actual ability to repay rules and the various options. Those rules don't apply to reverse mortgages. Again, most lenders don't do reverse mortgages, so not a lot of help there. But a temporary or bridge loan with a term of 12 months or less, yeah, that'll come up occasionally. The construction phase of 12 months or less of a construction permanent loan, yes, that'll come up for many of you from time to time, so that one's fairly practical. Now, the ones under items 4 and 5, the rest of page 4 and page 5, not likely this is going to impact you. If your bank is a housing finance agency, which I don't think you are because you are a bank, you don't have to worry about this. If you've been designated as a community development financial institution, and there are banks and credit unions that have been specially designated as community development financial institutions, but there's not a whole lot of those. But if you happen to be one, good news. All the extensions of credit you make are not subject to this. Item B, if you've been designated as a down payment assistance through secondary financing provider, and I can't even tell you how many of those are out there, but don't think it's a huge number. The next one, if you've been designated as a community housing development organization, and again, that's probably not your bank. Over on page 5, if you're tax exempt, if you got a determination letter from the IRS saying you're tax exempt, a nonprofit basically, and if you meet certain conditions, you extend credit secured by dwelling no more than 200 times a year. You extend credit secured by dwelling only to consumers with incomes that did not exceed the low and moderate income household level. Item 3, the extension of credit is to a consumer with income that doesn't exceed that level. Okay? And then item 4, the consumer has a reasonable ability to repay. So, on that last one, if you determine they have a reasonable ability to repay, you don't have to determine their ability to repay. Don't you love that one? And then the last one down at the bottom of page 5, item 6, if you got an extension of credit made under the Emergency Economic Stabilization Act 2008. And there's various programs there. If you happen to have a program under that, those loans, the rest of your loans may well be covered, but those loans would be exempt. So the big thing to remember, consumer credit. Reg Z applies, right? We're talking about Reg Z. Consumer credit transaction secured by a dwelling. And notice it doesn't say principal dwelling. So somebody's got their home in town and they got their place at the lake or the beach. Loan secured by either of their dwellings could be covered here. Now turn over to page 6. We have we call a decision tree here that put in here for you. And folks, we'll get into all the options here in a few minutes, and I apologize because the chart is complicated looking, but actually it's really not that bad. Listed down the left-hand side are your options. So when you're looking at ability to pay and qualified mortgage, ability to pay is the topic. The QM, qualified mortgages, that's some of the options that you have under this topic. You've got 7 different options, or as Mary Beth says, 6 options, and then one where you don't have to worry about complying. But, there's basically 7 ways you can go here. And when you get to the bottom of the chart, if you've exhausted your options, your loan doesn't fit any of them, well, you can't make the loan. Now, folks, it should be pretty darn rare that you hit that bottom box. And I've got them laid out here in an order that made sense to me, but you don't necessarily have to follow it. Now, again, if you've got a loan that's a QM, and there are several QM options here, that's like the Holy Grail. That's what you seek. And we'll explain later why having a QM is so important. There's a lot of advantages, a whole lot of advantages to having a QM. So that's where you start. And at the top of the chart, we have the basic QM option. So is your loan a QM? You say yes. And then we ask, well, is it a higher price covered transaction? And then you branch off to yes or no. And if it's not, well, then you hit a safe harbor. If it is, then you get a rebuttable presumption.